My riskiest investment ever. I own a little bit of this now, and I'm going to buy some more on Monday. All right, so check this out. This right here, and remember, I've been investing a long time, since 1993. And I didn't know what I was doing back then, and I've learned. I made a lot of mistakes along the way. But I've generally been an indexer, by and large, and I have bought some options. I sold some covered calls, never sold any naked calls, nothing like that. I've had owned some individual stocks, a bunch of Qs, the QQQs back in the days of the late 90s and early 2000s. And I got spanked and all that. Those weren't as risky as this. And this is a government bond fund, the Vanguard Extended Duration Treasury ETF, which I own a little bit, 100 shares now. I can buy probably another 100 to 200 shares on Monday. All right, so why is this more risky? All right, so first and foremost, let me explain how this works. We're going to go down to the portfolio, what they actually have in this portfolio. All right, and there's a reason you got to understand why this is risky. Portfolio composition. They got 81 bonds, all long-term government bonds. So there's no downside risk in terms of bankruptcy. Obviously, anything can happen, but you get what I'm saying. This is about as risk-free as you can get as U.S. government bonds. We have a duration of 24 years. And what that simply means is if the interest rates go up by 1 full percentage point, my portfolio in this fund will go down by 24%. All right, that's just a fact. That's what duration means. As interest rates go up, the price of your bonds go down by the duration. It's mathematical. It is what it is. So that's a significant risk. All right, now why is that happening? Well, because the most riskiest bonds that are out there are long-term zero coupons. Lower the coupon, the longer the maturity. LL. Lower the coupon, the longer the maturity. That's where your most risky bonds that are out there. So in this case, we basically got a 30-year bond, long maturity, with zero coupon. There is no coupon. It's not just low, it's zero. And the whole portfolio consists of that. Now, I think they have some bonds that have a coupon in here because their average coupon is 4.9. That tells me they have a few bonds that actually have a coupon that are paying probably long-term government bonds in there at some capacity. I don't know. I haven't looked at every single 81 holding, but zero coupon bonds have no coupon. So the average coupon presumably is of the bonds that have a coupon. So that doesn't matter. Right here, that right there, that means, again, the risk is significant. If interest rates go up 1 full percentage point, I lose a quarter of my money. All right? So far, so good. So let's take a look how this guy has done. Actually, let me just go into a little bit more of the risk as well. So remember, with the stock, look, I've owned stocks. Like I said, I've done covered calls. I've dabbled in stocks a long, long time. But stocks have an unlimited upside. It can go to the moon and beyond. And they have a finite downside. It can go to freaking, to heaven, and it can go to zero. That's it. So we know for a fact what the downside is. It can go to zero. Bonds have, I hate to say a finite downside. Government bonds aren't going to go down, but we know there is a downside essentially in terms of the price per share. It can get smoked, as I'll show you here in just a second. But there's a limited upside. There's a finite upside. A zero coupon bond works just like this. Basically, 2023, you buy a zero coupon for $35,000 for simplicity. It matures in 2050 for $100,000. There is no coupon. You're not getting paid to own it. You only get paid at maturity. That's it. That's how a zero coupon works. There is no coupon. There's no interest payment, if that makes sense. All right, it'll pay you at maturity. That's how that works. So we know for a fact the upside is limited. It's from $35,000, my par value, and I'm literally just pulling that number out of the air, to $100,000, the mature value. That's it. Stock, on the other hand, can go from $35 to $8 million, or you can go from 35 to zero. So in terms of risk reward, the bond is significantly more risky than the stocks because the upside is limited and the downside, while finite, is still pretty significant. In fact, this fund has a worse downside than even the S&P 500. I'll show you. So here's the S&P 500. The worst year was in 2008, 37%. The worst time frame, what's called a drawdown, was from 2007 to March of 2009. You can see right there. So they're saying February because they're not going into March 9th. It was really from October 1st to 2007 to March 9th of 2009. There was drawdowns about 52%, 53%, something like that. But you can see right here. So 37% is the worst calendar year. Basically 53% or so was the worst drawdown. I actually think it might be a little bit more than that, but I can't remember off the top of my head. All right, so now that's unlimited upside. All right, so if we look at the history of portfolio growth, 10,000. Let's go to 2009 because I just want to show you. We're going to compare to EDV. We're going to show you the growth 2009 we'll show the S&P 500 growth from 2009 has grown to 80,000 bucks. So I don't even know what that is. We put 10,000 in, it's grown 8 times. All right. So EDV on the other hand, if we go to EDV, right, extended duration bond fund, and we click on analyze portfolio, you'll see the max drawdown here was 51% right there. And that's from August 2020 to October 2022. Worst year was worse than the S&P 500. Worst drawdown was worse than the S&P 500. Look at that, dude. From August 2020, that was at if you put 10,000 bucks in, it was worth $22,000 in 2020. Now it's worth freaking 12,000 bucks. So over the course of since 2009, you've made all of 1.72 compounded annual growth rate. That ain't gonna get the job done. So there's less upside potential and a lot more downside risk on any given year, other than the fact that the stocks could all go finite to zero. Not gonna happen, but it could. So why am I buying this fund? Because I fully expect the bond market to take off once the Fed stops raising. I'm not actually sure that's happened yet. So let me give you so I bought this I think in February. I'm up a little bit. So here's our bottom right there. All right, so we're at 11,000 bucks in October 2022, and that's because they were raising, and then the bond market's kind of bounced around a little bit. It hasn't done a whole lot, and we're up. That's a decent amount from 10,009 base 11,000 to 12,500 or so. But still, the bond market is kind of dancing around here. But after this shellacking, I actually think the bond market is, because I think the economy is taking a big turn for the worse. In fact, I was just reading Jeremy Siegel today saying the same thing. It's like, damn, even Siegel saying that? Because Siegel's irrationally optimistic, if that makes sense. Now, and who knows? But anyway, so if the economy is going south, and at some point the Fed is going to most likely reduce the interest rates, that would also give the 25% upside on the duration. Because again, the duration covers both the down and the up. If the interest rates go up by a point, you lose 25%. If interest rates go down by a point, you lose 25%. Now, the concern I got is that right now we have such an inverted yield curve, like I talked about my thing yesterday, that so we're up here at 4.75 as the Fed funds rate, and right here the 10-year Treasury is at 3. Well, actually, let's do the 30-year Treasury is at 3.6. Whereas, so this guy would have to drop significantly below this guy before this guy starts dropping. I would think. I don't know that to be true, but to maintain a normalized yield curve, which is a positive sloping, that you get rewarded more for the longevity that you're locking up your money. So that doesn't necessarily mean that while the Fed funds rate will go down, the long-term rates will go down too. I don't know. But I just think the reason the Fed funds rate would go down is because the economy is slowing into recession. And when that happens, people are more inclined to sell their stocks, especially with high valuations, and lock in long-term government debt. That's exactly what we saw in the late 70s and early 80s, for sure. We saw the PE ratio collapse on stocks, and people weren't rushing in to buy bonds necessarily because of the inflation, but they were certainly selling their stocks. And I think now they would go into government bonds because they want to lock in something secure and safe. So let's take a look at what Japan looks like. Because even while, there we go. So even, let's take a look at Japan. So it's tough to see that the rate's dropping. Let's take a look at the Japan markets here. I think we look at government. Hold on a sec. Here's Japan, and you can see they've had low interest rates hovering around zero for a long time now. We're going back 20 years or so. All right, and so the reason for that is an aging demographics. The reason for that is the economy is just not on its back, but definitely not. There's no growth there for sure. And so we've had instances that they're raising the rates, lowering the rates, raising the rates, lowering the rates. And so that's my risk that I'm willing to take. I'm saying I think we're going to mimic a Japan-like economy, at least for this section of my portfolio. And if I'm right, I'll be rewarded nicely because we'll go from 3%, 3.5%, down to 2, down to 1. That could be a very profitable trade. Now, if I'm wrong, on the other hand, and we're down here, we go up here, I'm going to get crunched. No other way around that. I just don't see it happening. I don't see it happening. But that's the risk I'm willing to take, man. And, so people say, look, Japan's still an economy. It's still like the third largest economy in the world, fourth, something like that. I mean, so while it's not growing like leaps and bounds a la pre-1990, it's still there. It's still growing. It's still making money. There's still businesses. They're still paying people and stuff. I actually think that's the economic model that we're going to be looking at. A rapid deceleration in growth. deflation, low interest rates, low inflation, low unemployment, an aging populace, aging demographics. Probably won't be quite as bad as Japan because we do allow immigration and whatnot, and we're a little bit more, what's the word I look for in the United States? A little bit more entrepreneurial, but it's Japan-like, I think, or light, I should say. And I could be wrong. And if I'm wrong, I'm going to get swamped. It's hard to imagine getting swamped after a 50% decline, following up with another 50% decline back to back. I just don't see it happen. But literally, no one expected last year's government bond debacle, so anything could happen. I just thought it was interesting. I thought you might like to hear some thoughts on this. So we'll see what to do. See what happens. But like I said, don't buy this because I said. I'm not telling you to buy it all. In fact, if I buy, you should freaking stay away. You should go like this. Stay away, Josh, because your investments stink. But at the end of the day, I thought it'd be fun to talk about. Love to hear your thoughts. Don't forget to subscribe to Doobie Doo. Don't forget to subscribe to Locals. And don't forget my new book, my friends, Relax and Retire. And my 50% off my retirement course. Just use the promo code TAX, and all that stuff's in Doobie Doo. The promo code is TAX in my retirement course. All right, love your thoughts. We'll see you.